What's up, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex, and we're going to be going over BBIG. Very watched stock in the market right now. Implied volatility is through the roof, so people are anticipating a really big movement for this stock. And as we can see, it's making some pretty big moves in the market lately. So last week, a lot of people were looking at the stock. Implied volatility was high, but the stock was not really moving. So Tuesday, when the market opened, it did have a huge run up, and we are seeing another green day with the stock, though it did taper off towards the end, giving up most of its gains. So it's sitting at a price point of $10 per share, and it has a really solid support at this $10 mark. So if we see a nice bounce from this $10 support, we can see this stock go to new all-time highs. A lot of people are anticipating really big movements with the stock, especially for the bullish side on call options. If you take a look at the barchart.com highest implied volatility stocks, BBIG call options are definitely taking the number one spot for highest implied volatility. A lot of people are anticipating this stock to continue squeezing. This is a retail favorite by many investors looking for the next hottest thing, and this stock is definitely no exception. Tons of movement in this stock right now. As we can see here, implied volatility rank is at the highest it's ever been. This means that implied volatility is at its all-time highs, which is indicating that the stock is going to have a really big movement. Now, we don't know if that movement is going to be to the upside or to the downside, but we do know that it is going to be in one of those directions. So a lot of people are pouring their money into options, especially call options. As we can see here, tons and tons of premiums are being bought for the call side, and this could actually set off a nice gamma squeeze if we see BBIG closing pretty high when these options actually expire. So call to put ratio is 92. Tons and tons of premiums are being spent on calls, specifically short-term call options. As we can see here, a lot of people are buying the September 17th as well as the October 15th expiration dates, which is 2 weeks out. Well, the 17th is actually 1 week out, and then this October 15th is 1 month out. So very short-term contracts right here, because obviously this stock is definitely going to be mostly hyped up by the retail investors and just by a lot of sentiment, a lot of bullish sentiment rallying this stock up. So dominant strikes, we're going to be having the $10, $11, $12 strikes for the call options, and we're going to be taking a look at these call options. Implied volatility is going to be pretty high. It's going to be pretty risky. Don't really recommend the September 10th expiration. There's just not enough time, and you're most likely going to lose your money. But giving us a next week expiration date is going to give us some more time, or you can even do an October 15th expiration date, which is going to give you even more time. So recently they did actually add some more expiration dates, but the 17th and October 15th are going to be most popular. So if we take a look at the call options, you can't go wrong with any of these strike prices. But keep in mind that because implied volatility is very high, over 300%, the premiums are going to be pretty high on these contracts as well. So if you're pretty bullish, it's going to be risky buying these call options. So what I recommend instead is going to actually be just buy and hold shares of the stock. It's a very cheap price stock. 100 shares is only going to cost you $1,000. It's not going to break the bank. And with those shares, we can sell some covered calls. We can see the premiums on the stock are very high. So we can sell a call option if you're looking to double your investment. If you do think that the stock is going to go to $20, you can sell a call option at the $20 mark for September 17th. You can be collecting a lot of premium right here, $83 per call option that you're selling. So if you have 100 shares, you can sell one of these. 200 shares, you can sell two. And that's how covered calls work. You have to put down 100 shares as collateral. So selling a call option like this, you're going to be collecting $80 of premium. That's pretty good, especially with how inflated the premiums are. This call option in particular has 453% implied volatility. So very, very inflated premiums, as we can see here. A lot of people are pouring their money into these call options, inflating the premium price, which is very good for option sellers because we're betting against the gamblers, and it's going to be a little bit safer. So the upside here is we're playing a really safe strategy, and but the downside is our max profit is going to be capped at a 100% gain, basically doubling your investment. Because if BBIG goes above $20 at expiration, September 17th, you have to sell 100 shares at $20 strike price. So whatever strike price you choose, you have to be comfortable selling your shares. That is how a cover call strategy is going to work. So very, very high premiums, and you can go further down the strike prices and collect some more premium. But something like a $20 strike price, you can't go wrong. It's very unlikely the stock is going to double in 1 week, but we do not know, and we cannot predict the future. And implied volatility is very high, so anything can happen. If you don't want to buy shares, or you want to end up buying the dip, we can go on to the put side and sell some cash secured puts. You're basically getting paid to buy the dip when you're selling a cash secured put. And if you go back to the options dashboard right here, dominant strikes are going to be actually the 23 strike and the $15 strike, as well as $11 strike for the put side. So it looks like people are buying some in the money put options, which is very interesting. But the premiums overall are definitely going to be inflated across the board. You can collect some really nice premium, as we can see here. If you want to own 100 shares of the stock at, say, $8 each, which is really good cost basis, it is $2 under the current stock price, which is negative 20%. You can sell an $8 strike put option, and you're going to be putting down around, let's see, you're going to be putting down $710 of collateral. If we take a look at a calculator here, calculate our percentage return. This is going to be a very high return. It's going to be very risky because, as we said earlier, we don't know what's going to be happening with the movement of this stock. And unlike the biotech stock that we analyzed earlier, FBRX, this is not a biotech, so it's not going to completely tank 90% in a day. So this is going to be a little bit safer. As we can see, this is going to be a 68% chance of profit. Really, really high chance of profit. Really good option strategy. If you want to be safer, you could go further down the strikes. I probably will do a 7.5 strike to be a little bit safer. I like to be on the safer side and make that guaranteed profit. But let's calculate the rate of return on this $8 strike. So it's going to be $710 of, it's going to be $90 of premium we're collecting divided by our collateral, $710. That's going to be a 12.67% return in just a week and a half. So really, really high return. You're basically making the stock market return in just a week and a half. So it's going to be pretty sweet if you sell multiple of these contracts. If you have, say, $8,000, $7,000 in your bank account, in your buying power, you can sell 10 of these contracts, collect $800 or $900 of premium in just 1.5 weeks. So really, really good risk-reward ratio right there. But I personally will be selling probably a $7 strike. We'll take a look at the profit there. Let's get rid of that. We're going to be collecting $40 of premium for one per contract, with a collateral of $660. So let's calculate our premium divided by our collateral, 660. This is going to be a 6.1% return in a week and a half. So I like that risk reward right there. But of course, if you are really bullish on the stock, you can sell a further up strike price and collect some even more premium. But personally, I am going to be doing the $7 strike and I do think that it's pretty safe. 77 chance of profit, and we're collecting 6% return in a week and a half, and that is going to be pretty good. So that's about it for this video. If it helped you in any way, please leave a like, comment down below what your thoughts are on BBIG, and of course subscribe if you're new to the channel. It helps out a lot. Thanks for watching.